Welcome to online mentoring session for the paper Strategic Financial Management, paper 2, final level. And today's topic will be merger, acquisition and restructuring. I, C. Ashish Gupta, Deputy Director, Board of Studies, ICI, will mentor the session. Students are requested to go through the disclaimer statement. This lecture has been delivered by faculty members of ICI, and these are to supplement your study material, practice manual, and other contents that is available on ICI website. And please note the views expressed in this lecture are completely of faculty only. There is no council, neither I, nor our institute ICI will be held responsible for the same. Students are also requested to note down these important points. So far as the amendments, etc., is available concerned, please student note there is a very huge rumor in the market that there is a change or there is an amendment in SFM syllabus since supplementary has been brought out in January 2016. So there is a rumor in the market that there is an amendment in the SFM syllabus, and some even private coaching centers are conducting their classes. So please student note there are no such amendment in SFM syllabus. Syllabus is status quo. This even not even change of single word. The supplementary has been brought out only to provide you some additional practice question, as well as to you say or you say to introduce or you to introduce the changes or whatever the changes in practice manual and study material of January 2015 edition are there, that has been brought out in the itself in the supplementary. So please don't go don't worry, there is no amendment in the syllabus. Now students are requested to go to the student learning management system. At video e-lectures are available, and the access is free, and you have just to need to register with your student registration number and start learning immediately. Now first of all, in today's session, as I told you earlier, we shall discuss the merger, acquisition and restructuring topic shall be discussed here. Students are requested and they are free to ask their queries relating to this topic during the session. So please don't wait, the session should be over. You can continue to send your queries during the session, and that will be replied appropriately. Now some queries we have received, that is problem in restructuring. Student, since from these only three words, the nature of exact query is not clear. However, restructuring I will discuss later, because when I will discuss all the form of merger acquisition, then I will take up this topic. So don't worry, just have some patience. I will discuss in detail. One student has sent one attachment with his query. Friend, I have seen your attachment, but your attachment does not contain any query pertaining to this topic, that is merger and acquisition. So we cannot, because normally he is saying what is characteristic line, and there are some, because normally this query is related to the portfolio session. So I will reply your queries either through email or I will give you a personal telephonic call. So because this session is specially for merger acquisition topic, so I will take up this query separately. There is one query, wanted online videos. So this query actually relates to the technical people, and I will forward your query to the concerned EDP section, so they will take care of it. Now, one common query is revision. Friends, this is one of the very common query that has been discussed in earlier session also. So, although we have discussed in greater detail, but here I will just give you some small tips. First of all, just refer ICI's practice manual, RTP, suggested answers, and study module. Next, refer any financial newspaper on daily basis, because that will make you abreast about the contemporary development in the field of financial. Any one newspaper you can refer. Most important, read thoroughly comments on the performance of candidates that is published in Students Journal, because it is a learning from the mistake of others. In these comments, the various points where student normally commits a mistake are clearly and well defined, and these are normally, it is not our comments, it is the comments of the examiners who evaluate the sheets. So if you go through these comments in a greater detail, then you may come to know where I can commit a mistake. So this is one of the best method. Next, attempt mock test. That is most important, because sometime what happens after clearing your IPCC and or intermediate examination, there is a gap of about 1 year or more than 1 year. So students normally do not have the practice to attempt the exam in a 3 hours time, and due to this sometimes they even lose their patience in the exam or mental balance. That leads to blunder, and ultimately what as they can do best, even they cannot do it, and what resultant is that they got very less marks in which they are very confident. So I will advise you just attempt the mock test in the examination like conditions, and normally your regional branches conduct this type of mock test, or even you can download the mock test at your own from the website, and you can send at BOS for evaluation at our end. However, if time will permit, I will throw some light on this topic, revision more respect also. But now I am coming to next query. Basic understanding about the steps. What steps? This is not clear. So, if student can contact at my email ID that I will disclose in my last slide, that he or she can send me an email on with more detail, then I will reply. Now, friends, let us start with the topic merger and acquisition and restructuring. Friends, plainly speaking, I am just drawing a small diagram for your understanding. Now, merger can be through absorption, or it can be through consolidation. Acquisition is a process whereby one company buys another company through purchase of shares or through purchase of asset. So, normally acquisition term is not used in a good sense because acquisition sometimes has been seen a forceful, and in this case this form acquisition forms take the form of takeover. So however there may be we will discuss some forms, or you can see in your study material there are some you can say strategies to safeguard, to take, or you can say take over defenses. I will discuss it also. So now once whatever be a form of acquisition or absorption, this can be further classified into three categories. One is vertical, another is horizontal, and another is conglomerate. I am coming to next slide because space is not sufficient that I should continue. I am here writing again vertical, horizontal, and conglomerate. On a vertical, normally what happens, it is in a same type of industry. Generally these are acquisitions are to gain the control, or you can say you increase the market share, because when you will buy the competitor's firm, of course your market share will be increased. Horizontal work can be further be classified into backward, and another is forward. Now, in a backward vertical merger, normally a company acquires suppliers from or business. Oh, I think I got interchange. Sorry for the mistake. In a vertical, in a backward vertical, normally the suppliers business is acquired to ensure the supply chain of raw materials, etc. Whereas in case of a forward vertical merger, customer or dealers business is acquired to ensure the quality control, or even you can say to avoid the monopolistic position of the supplier or the dealer. Now, when we talk about merger acquisition, broadly there are two aspects. One is regulatory, another is financial aspect. Although the regulatory aspect is not within the purview of our syllabus of SFM paper, that is covered in other papers. So the Indian regulatory framework, when we talk about, so relating to transaction, some acts are relevant here, like Companies Act, Income Tax Act, Competition Act 2002. In case of a listed companies, in addition to above, more regulation are like SEBI regulation, stock exchange. If the then listing agreement comes into picture. And if our acquisition is cross border, or it is crossing the boundary of India, that FEMA, that is Foreign Exchange Management Act 1999, also comes into the picture. So this is broadly the regulatory aspect that we will not discuss here. Now I am coming to next point of what are the takeover defenses. I am just giving you the briefly the name. Student can refer all these defenses from the practice manual as well as study material. One is Demerger, another is crown jewel, poison pill, poison port, green mail, white knight, golden parachute, Pac-Man defense. The objective of all these strategy is to make the target company unattractive. So I hope with this the concept of merger acquisition to some extent has been clear to the student. Now let us go back to the student query session. Let us see whether we have received any queries or not. We have not received any questions, so we will continue with our discussion. Now, when we talk about merger acquisition, see, merger acquisition are normally changed in the interchangeably. The reason is that so far as the financial aspect is concerned, from financial angle, there is nothing, there is no difference between acquisition and merger, because normally whatever the issues are involved, they are both are that issues are common in both cases. So first issue come in financial aspect is a valuation, that is valuation of target and even acquirer also, because that will give the dealing structure, deal structuring, that is called deal structuring, because once the valuation will be established, because it is not see, merger acquisition is not an easy job. There are a lot of intricacies are there. Once merger acquisitions has been established or there some decision has been made, so next question comes ki what is the valuation, because everyone's acquirer says I am more valuable, acquired says I am more, target company says I am more valuable. So whatever the valuation, that will provide the dealing structure, that is how the deal will be settled. It can either be through cash or it can be through debenture issue. Normally these are very rare, and most common form is the issue of shares. So when issue of shares are there, the aspect of exchange ratio comes into the picture, normally on which the questions in the examinations are asked. While we are doing our valuation part, valuation can, I as told you earlier, it can be for deal structuring, or we can dealing structure to draft the dealing structure or to decide about the ratio. And sometimes it can also be used as a capital busting decision also, where we have to decide whether we should go for the merger or acquisition or not. It can consider in that way also. So student, please, whenever you are referring the chapter of merger acquisition, so it may possible you may find some capital busting like questions also there. So they are not the purely capital busting questions are there, although merger acquisition aspect are there, but decision is based on the capital busting method. Now when we talk about the valuation, so valuation, there are various methods, and this list cannot be say exhaustive. The valuation or the relative valuation normally used for comparable companies, and normally these are called like proxy entities. Sometimes what happens, this problem normally comes into the unlisted companies. See, listed company have no problem because normally their shares are quoted in the stock exchange, and when their shares are quoted in the stock exchange, so it gives a fair idea what is their market valuation. But problem comes if a company is unlisted, then no one knows what is the real value of the same. What is the real value of the share of a company? In that case, what happens? We go for some proxy entity, that is, you can say it is kind of a, in an industry, say we find any other company, or we can say we look for any other company in the same industry whose share is listed, and on that basis we compare our parameters. There are some there can be some parameter like sales, capital, but there can be any type of parameters, and on the basis of these parameters, the parameters of the acquired company are compared, and accordingly we can compute the value. I will take up this question in my presentation. Otherwise, I will let you know the which questions exactly are there in our practice manual that you can refer for this. See, student, what happens? In my opinion, whenever you attempt any question, so please don't cram the question. Please have some basic understanding of a question. Only then you will, it will be very easy to handle you the problem for you. Otherwise, once you start cramming the questions, then you are not, what you are doing, you are just cramming. It will not help you in future also. Now another model is discounted DCF model. That is normally free, available on a free cash flow to the firm. Now these questions are also there, and there is another diluted version of the same, that is free cash flow to the equity. Now this topic is covered in your security valuation chapter there, because in security valuation we value the equity, but however, since here we are valuing the total firm or a company, then we say free cash flow to the firm. There's one method. There is one method also, dividend discount model. That is very simple. It is nothing but it is a reverse of cost of equity. If you really ask me, it is a cost of reverse. It is a reverse of cost of equity. If you reverse the cost of equity, you will find the value of the share. Like if you remember, what is the formula? D1 upon P plus G equal to KE. Now here you will be given this, you will be given this, you will be given this. Just you need to find the same. There is another formula, another method is used, that is called value analysis, and that is EVA, economic value added. There are some more versions also, shareholder value also, but normally best frequently asked in the examination is EVA. Now this was the one aspect. Now since I am taking in the beginning, now I am coming to the restructuring. Since space is not enough here, so I will take up this separately. Now what is financial restructuring? The student was asking one query, restructuring. I think he was.
Nowadays it is very important.
Yes, certainly. Financial restructuring. Now it is a kind of an internal arrangement. First of all, it is not. What happened? You don't involve any outside agency, although outside agencies are involved, but directly you are not coming into the you can say merger or acquisition kind of a thing with some outside entity. Whatever arrangement you are doing with your debtors, your debenture holders, your lenders, and even your capital provider, that is shareholders. So broadly, this strategy is used when your balance sheet have a huge losses here. So what happens? Your balance sheet does not look proper, and in order to this, you can say cleaning the balance sheet. In my opinion, it will be called cleaning the balance sheet.
it is very hot topic because nowadays everybody is listening that the RBI has taken initiative to clean the books and
Certainly.
NPAs will be cleaned because NPA is shown on the liability side. So it is very much essential for the
Certainly.
banks to show their balance sheet very attractive by cleaning those liabilities. So by restructuring, the banks are doing their liability, they are reducing their liability so that it can seem very attractive. So restructuring, whether it is debt restructuring or balance sheet restructuring, it is generally concerned with the internal kind of arrangement where it is generally done by the entity itself.
Now I have been joined by C.A. Sanjit Lal Sharma. He is
I'm a chartered accountant and I am working here as a senior executive officer.
so he has joined me also, and he will also throw light on some topics as his knowledge in banking etc. is a good one comparing to myself. Is my confession. Now I am coming to this when this balance sheet we have to clean. So whatever something we have to reduce from here, unless we minus from here, it cannot be wiped out. So it may be possible that we may reduce the paid up capital of the shareholders and we may even write off some loan and paid off the balance. So we are cleaning, and even some may issue new shares. So even it has been also been seen sometimes some internal restructuring scheme, this loss has been wiped out or even some cash entries has come here. So this can also be possible. It depends normally on the perception of the market. It may be possible due to some problems. A company may not be performing well, but now in future everyone is confident. So the even lenders maybe support him. Now this was a case of financial restructuring, and I think there is one problem in our practice manual also. This is a good problem. So student can refer the same. Now I am coming to one more aspect, that is we have discussed a lot about merger. Now I am coming to another aspect that is called demerger. See, we are in a society and everyone has their own choice. When merger is a kind of a meeting of a mind, it may be possible. Demerger may be not meeting of mind, or there may be some other reasons also. Sometimes it has been seen that a company may have many divisions, and one division is performing very well, and others are not performing well. So it is a natural. The performing well division will start pinching. Why should whatever I am earning or what I am extra I am gaining on efforts, and on these efforts on my gain is distributing among the other inefficient units. So in that case, there may be possibility of demerger. In a demerger, there are three kind of a form. Friends, these three forms have been given in your study material. You can refer from there also. Here I'm giving you a very brief. In a spin-off, existing shareholders are given share in a new subsidiary on pro rata basis. Now we say there is a limited company. It has a three division, like one is pharma, another is mint, another is auto. So it may be possible the pharma may be performing well. So a company may, a pharma limited company can be formed, and the share will be distributed among the original shareholders of a limited in the ratio of their original holdings, pro rata basis. And there is one question in your study practice manual. Please note down the question number, that is question number 29. That is a perfect example of the spin-off. Normally student got confused. This is a new concept. This is nothing new, but it is a spin-off concept there is. Now in an equity carve-out, what happens? Parent company does not issue all shares to existing shareholders. Rather, even they sell some shares sells in market or through IPO. Normally it is through IPO. So in that case, what happens? In this case, there is no cash inflow in the company, but here there will be the cash inflow in the company. Normally this form is usually taken in a case of, you can say it is kind of a buyback arrangement also. Sometimes company may have a good reserves, etc. And by this, even they can, you can kind of say buyback or dividend kind of arrangement is there. So, but here there will be inflow of cash. Now in split off, what happens? Just like spin-off, the existing shareholders are given choice, but with the rider. The company says either you continue to hold the share in the original company or in this company. They cannot hold the share of both companies. So now it comes the question of their perception of shareholders. As they are given the choice, there is no compulsion. So they can continue to hold the share of a parent company, or they can go for the new company. So I hope the concept of demerger must be clear to the student. Let us go back to the query session. I think we have not received any query. So let us continue with our session. Now, I'm just describing normally what type of questions are examination. See, I'm just telling you, it is not an exhaustive list, because tomorrow you may not say कि sir ने बताया नहीं था, or you sir has not told it. But I'm saying just whatever bit of time of you type of a question normally asked in the examination. Some questions are on evaluation. So question number 7 to 8, 19, even 30, 35 to say around 39 question number. These are question numbers. So in a practice manual edition 2015. So now these are questions on a valuation aspect also. Other aspects are also there, but some are purely valuation question. One, even I have taken one question in my current session today also. Now there is another value of acquisition. It is a kind of a capital budgeting decision. So question number 37 is there. Now there is one question, valuation of company plus exchange ratio. So that is 35 to 39 approximate, and even 30 is there. And there are some other questions are also there. Now there is another calculation of swap ratio. Normally this is a very common type of a question. What should be the swap ratio? Swap ratio means deal structuring. Here the part of deal structuring come here. See, whenever deal structuring, I will cover one point also, then I will come to next point. Then calculation of maximum exchange ratio. So normally 20 to 117 17 number questions is there. There is gonna another type of a question, gain in EPS public market value. So some questions from 11 to 16 are questions are number question numbers are there. That is question number from 11, that is 11, 12, 13, 14, 15 and 16 are there. That will give you an insight of this aspect. Friends, it is very important to note whenever there is merger and acquisition. So normally one company is at a loss, another company is at a gain. So, and because if you try to maintain the EPS of one company, then suddenly the other company will be in the loss. However, if their basis of is EPS, normally then it is not so. Then they are, both companies are well in the same position. Now another case is internal reconstruction. The question number 40. Merger as purely capital busting decision. Question number 48, 41. And demerger, as I told you earlier. Spin-off. Best example. Now, friends, here please note. Here it has been given the case of spin-off. It may be possible. Same question can be modified on the line of split-off. So please read the question carefully. Just not try to attempt the question blindly. Oh, this question is from this page, not like that. Please read through the question, as I always insist on the same. Now, last point, proxy company. As I told you earlier, the similar type of a company may not be a listed company is there. So it is better if you go for any proxy company. And for this, there are two questions. One is 38 and another is 39. Although there is one chop shop method, I think, is attached with it. So chop shop method is nothing but is a method of valuation where you say value the each division separately instead of a company as a whole. You just try to value their each division separately. So it's called chop shop method. But here the concept of proxy company has been used. Now, friends, with this, I am coming to the question answer, some examples where I have taken some questions from our practice manual. So we shall continue the same. But before that, it is better if we look at the query session. What is a reverse bid? Okay. Friends, reverse bid is means nothing but it is called, you can recover as reverse takeover. It is a case, it is not a case of demerger. First of all, please note, it is a case when a small company takes over the big company. Normally, this strategy is adopted by any unlisted company, and since to list its share in the market, it may have to follow a long procedure, etc. So what it does, it applies a shortcut. It go for a company that is already listed on a stock exchange, although it may not be performing well, but a company may be even bigger than it. But unlisted company may have the smaller, but is performing well. So in that case, it may be possible the smaller company may buy the bigger company. So by bigger process, the unlisted company will also start getting the listing. This is called reverse bid. Sir, can you explain the question number 32? I think I have tried my level best. Anyway, I have some questions. This is question, I think, referring from the practice manual. Sanjit, please check the question number 32, chapter number 13. This is Avantika Jain. Beta, we will try to take up your question. First, I have some questions. Otherwise, I will also take your question. No problem. Okay, this is question number 32. This is calculating the valuation on the basis of current expression. Okay. I think this is a very simple question. Anyway, I will try to cover it up also because it may be possible that you may have some alternative solution in the end, I hope, because some student has said, sir, it has an alternative solution, so we can, I will discuss it. Don't worry, I will take it. Now, this is a question number 8 from the practice manual edition 2015.
ABC company is considering acquisition of XYZ Limited, which has 1.5 crore shares outstanding. The market price per share is rupees 400 at present. ABC's average cost of capital is 12%, and the available information from the XYZ indicates its expected accruals for the next 3 years are as follows. For the first year, 250 crore. In the second year, 300 crore, and in the third year, it is 400 crore rupees. With the help of this information, you have to calculate the range of valuation that ABC has to consider.
Okay. Now, friends, it's a very simple question of valuation. Now, here, the two broad aspects that is method will be used. One is based on market price, and on the basis of given facts. Friends, whenever you attempt any question, so it is you need to cram what I will reply this method. Don't worry. You see what are the data available with you. Now, here it is simple. When data of more than 1 year is available with you, so and there's a cash flow is there, so you can also say it's a free cash flow method you can also use. So valuation, you can say it is a kind of a DCF cash approach. Since free cash flow what has not been used, you just use discounted cash flow approach. So here we have a two methods. So one is our market price. So market price is available. We need not to worry about the same. So I start solving the question and you see my approach. First of all, market price method basis. Friends, please also refer the mode of presentation from practice manual also. It may be possible my mode of presentation slightly deviating from it, but you can refer the same or you can continue with the same, but it is this hardly matters. Market price per share is equal to rupees 400. So value of the business will be simple. Number of shares are available is 1.5 crore and per share is 400. So total worth of the business will be 600 crore. I think it is very simple. Now coming to our next valuation on basis of DCF. So in DCF, since our cost of capital is there 12%, so it means the company is, as I told you earlier, it is a kind of a capital budgeting kind of a decision. So company will use the discounting rate of 12%, and what it will do, it will compute the present value of cash flows. All these figures are in crore. So this is the value of as per discounted cash flow approach. Now we can compute the value of per share on the basis of this approach. Since number of shares are 1.5 crore, so value comes 498.10. So now two values are with us. The range is 400, 498 point. So very simple, range of valuation this is per share and this is company as a whole total. Here it is 600 and maximum is 498.10 and here is 747.15. So I hope it will be clear. I'm coming to the next question.
This question, A Limited wants to acquire T Limited and has offered a swap ratio of 1:2. That is, for every share of A Limited, the 2 shares of T Limited will be given. The following information is provided. The profit after tax of A Limited is 18 lakh. For T Limited, it is 3,60,000. The number of equity shares outstanding for A Limited is 6 lakh, and for T Limited is 1,80,000. The earning per share for A Limited is rupees 3, and for T Limited rupees 2. The price earning ratio is given. That is, in case of A Limited, it is 10 times, and in case of T Limited, it is 7 times. With the help of these two EPS and PE ratio, you can also calculate the market price per share, though it is already given in the question. For A Limited, it is 30, and in T Limited, it is 14. With the help of this information, you have to find out the number of equity shares to be issued by A Limited for acquisition of T Limited. So first requirement is you have to find out the number of equity shares to be issued. Number second, what is the APS of A Limited after the acquisition? That means after the acquisitions, what will be the earning per share of the A Limited? That is the what is the effect of acquisition? That means you have to find out the earning per share of A Limited post merger. Third requirement is determine the equivalent earning per share of T Limited, and fourth is what is the expected market price per share of A Limited after the acquisition, assuming its P multiple remains unchanged. That means the P multiple for A Limited will remain unchanged. That means it will remain 10 times, and you will have to find out the expected market price after the acquisition. That is post merger, post acquisition. So now we will see how it can be calculated.
Friends, here, see, in a questions, as Sanjay has told you, the market price may not be given you, so you can easily calculate. This is not an issue. Or it may be possible, PE ratio may not be given you in the question. And this, see, there are these three informations are there. So even one information is missing, so you can calculate the same. So it may be question like also that. And one is saying is a PE ratio multiplier shall remain unchanged. It may possible you may be provided some with some separate, or you can say with a new PE multiplier also there. So in that case, your question solution will be changed. So please don't cram it. Now let us see how we attempt the questions. First of all, number of shares to be issued. Since it has already been mentioned, for 2 shares of T Limited, 1 share of A Limited will be issued. So, or you can say that way the exchange ratio is, you can write anyway, it hardly matters, is 0.5. So the number of shares of, since number of shares T Limited are 1,80,000, that is given in the question. So number of shares are 1,80,000, and since ratio is 0.5, so 90,000 shares will be issued in A Limited to the shareholders of the T Limited. That is, any shareholder of a T Limited having 1 share, you will get automatically 0.5 share. Now, next point, it requires what is the EPS of A Limited after merger, after acquisition, sorry. Since it is a clear cut case of acquisition. Total, now since both companies have been merged, so their earning will also be merged, and this 3,60,000 will be there. Synergy is not there. Sanjay raised a very good question. One aspect, even you can say I have skipped in from my mind. Sanjay that made me recall. One aspect of the merger acquisition is synergy. And for synergy, there is one famous thing. Value of A plus value of B is less than value of AB. So what is the difference in the value? That is called synergy benefit. So it may be possible, you may be provided in the examination, the value of synergy is this much, then your answer will be changed. So there can be any possibility, and I'm thankful to Sanjit to make me recall of the synergy aspect that has been skipped from my mind. Now with this 2160 lakh, now number of shares, since after merger 6 lakh were existing, 90,000 new shares have been issued. So total number of shares after acquisition will be 6,90,000, and accordingly new EPS will be 3.13. Now after that, third point, it requires equivalent EPS. Equivalent EPS means a shareholder having one share. So how much it will be equivalent in the new company, that is in A Limited. Now, since number of new share will be half of one share, so EPS of new company is 3.13. So equivalent EPS will be 1.57. Okay, I hope the student it is clear to the student how we can attempt the same. Now, next it says what will be the market value if there is no change in the. I'm taking on a next page slide. What will be the new market price of share after acquisition? I will continue with the 10 because it has already told you that it will remain the unchanged. So it is 10. So it shall remain the same. Now expected EPS, it is 3.13. So very simple, expected market price, it will be 31.30. So friends, here you can see there is a benefit of to the A Limited and as well as to the T Limited in the market price case, because it's a very simple logic. I give you the explain the logic for the same. Sometimes you may be asked what is the why there is a benefit to the both companies, because if we divide this figure, say although the shareholder of it will get a half share, so the price will be roughly, it will be around 16 something like there will be. Just 15.6 13, it will go by the same 15.65 approximately. The value will be 16.5. Now this value is more than rupees 14. So why this so? This is why, because here, because no synergy is there, Sanjay, there is also, but one thing very important note, here the P ratio of 10, and here it is the P ratio is 7, so it has been increased. So with the merger, the impact of PE gain has been gone to the T Limited also. It may be possible that if this company has a higher PE ratio, then this would have been reverse position. Okay. So student can be asked question in examination in any way. So I always insist, please don't go mug up the questions and go by the facts of the questions.
He might have gone by 1.5.
It's so possible. Sometimes after merger acquisition, the P may go down, market may not accept the merger. So that can also be a possibility. Now market value of the merged share, total number of shares, our total value will be 215,97,000. Now, if I go by the words of Sanjit, because Sanjit is always interested in synergy. So, Sanjit, can we find out whether there is any synergy? Because this is not given in the question. Sanjit, just carry out some calculation, multiply the market price with the number of existing shares, then we will add up the same.
Okay. The existing market price per share of A Limited is rupees 30.
Into number
of outstanding shares is 6 lakh. Multiplying these, the total.
No problem. We just add up the first, then we will
18 lakh. So It is 18 million. It is
No problem.
1 crore.
And how many shares are there? 6 lakh, na?
6 lakh.
No problem. We will do it. Don't worry. Now next is our share of this 14. Okay, and number of shares are
1,80,000.
1 lakh. Now we add up this amount. Two 1 minutes.
It is 2 crore.
No problem. 252 lakhs. I think there is something there.
Yes.
No, let me check.
2 crore 52. 5 lakh 20,000.
2 approximate it will be. 1 minute. Let me check. So this figure will be this much.
2 crore 52.
Okay. Now you
5
can
lakh
see
20,000.
this figure is more than this figure.
Yes.
So the difference is synergy.
Yes.
Okay.
That's why I told you.
So I hope with this the concept of valuation and exchange ratio must be clear to the student. Although I will take some problem later on. Just let us go back to the query session. See, there is some question management buyout. See, Yogesh, management buyout is basically you can say when sometime what happens, a company, the company's management may be interested in, sometimes company may saying, yeah, I want to sell the company because it's not profitable at now. But however, the management is convinced that there may be some benefit of it. If we acquire the company, then or we can, because see there, if you remember, if you must have studied, I think in your intermediate level, there is a kind of a agency relationship, agency theory is there, where the management wants to don't lose their job. So in that case, what happens? They go for say, ki, okay, we will purchase the company, or it may be possible they even go for debt, go for taking the debt also. So that is called management buyout. Although the merger acquisition concept is always is there, but it is a purchase by the management itself. So this is called management buyout. Now let us go back to the.
In case of management buyout, management itself buy the company. Since management is very much acquainted with the company, its functioning, so
Yes.
it know very well whether to purchase the company it is beneficial or not. So in the case of management buyout, in instead of external buyer, the company is bought by the management itself. That's why the name comes. It comes from the management buyout because management purchase itself.
And sometime even one term may also become leverage buyout.
Yes.
In a leverage buyout, there is nothing by management buyout. Leverage buyout means whenever you buy a company and you take a heavy loan for this, that is called leverage buyout.
And the very interesting thing in case of leveraged buyout is that the management will pay the payment to the lender from the cash flow of the acquired company.
Certainly.
Yes. So it is very interesting. Though the management is purchasing some asset, that is a company, that is acquired company, and after this, it will pay the lenders from the earnings of the acquired company.
That is so.
Yes.
Because I think student can also refer one question in a supplementary. I don't know if it is supplementary or it may be somewhere, because I have included this question in a mock test also. Or I just give me 2 minutes. I just give you the name. Okay, student can refer the question number 6 of supplementary study material. Page number, I am just giving you the page number also. This is question number 6 of supplementary of SFM, that is in January 2016, and page number is A75. Please refer this question. That is a very beautiful question on the management buyout. So here you will come to the concept that Sanjay has told, that it will it is you pay out from the cash envelope, so that will help you. Okay, now let us come to the next question. This is question number 14 from the practice manual edition 2015.
In this question, XYZ Limited is considering merger with ABC Limited. XYZ Limited shares are currently traded at ₹20. It has 2,50,000 shares outstanding, and its earning after taxes amounting to rupees 5 lakh. ABC Limited has 1,25,000 shares outstanding. Its current market price is rupees 10 and earning after taxes are 1,25,000. The merger will be affected by means of stock swap. ABC Limited has agreed to a plan under which XYZ Limited will offer the current market value of ABC Limited shares. With this information, you will have to find out what is the pre-merger earnings per share and P ratio of both the companies. That means there is nothing, but you will have to find out with the help of these informations the earning per share and P ratio. And the second requirement is if ABC Limited's P ratio is 6.4, what is its current market price? That means you will have to find out the current market price of ABC Limited with the help of
New
P ratio
that
of
has been changed.
6.4.
That will change because
Yes.
in earlier question it was told it shall remain the
Yes.
same, but now it has been changed here.
And what is the exchange ratio? And what will XYZ Limited's post-merger EPS be? And number third requirement is what should be the exchange ratio if XYZ Limited pre-merger and post-merger EPS are to be the same.
That's it. Now let us see, it's a very common type of a question. I will say it is a very common type of a question. Now, friends, in my opinion, the first part is nothing. But first part is nothing. It is a kind of a calculation. It's a tabular presentation. Now let us start with the solution. So it may be possible whatever with this part I am solving for you or it is given in the practice manual, that may be given you in the question itself. In a previous question, every one table has been already given to you. Now here you have to draft the table. So don't say, sir, it's a very lengthy question. It's a very small question. It's a very simple question. Just you have to carry out some simple calculation. Now XYZ Limited and here ABC Limited. Now earning after tax is given to you both companies. This is 5 lakh. In case of this is 1,25,000. Number of equity shares outstanding. This is the 2,50,000, 1,25,000. Now with this, what will be the EPS? Very simple. 2. That A is a B, so A divided by B. We can say it is a C. We will use it later on. 1. Now market price has been given to us. It is 20 and it is 10. So if we say it is T, so we calculate PE ratio with the help of same ratio because data is given to us. Very simple, D divided by C. So it comes 10. Fortunately or incidentally, the PE ratio of both companies is the same. Now here we can see there we can no gain to the each company if this EPS PE ratio continues. Now next it says what is current EPS. Now exchange ratio has been given to us since it is on the basis of share value. Or it can be reverse also, that is 6.4 divided by 20, that is 0.2 share of 1 share of ABC Limited. Okay. Now post merger EPS of XYZ Limited. Now since earning is the same of this, here earning of another company is 1,25,000 and 2,50,000 are existing number of shares, plus as I told you, either we can do this way into 325 and the number of shares are the number of shares are 1,25,000. So by this we shall get a figure of 6,25,000 divided by 2,90,000, and our earning per share will be 2.16 of the merged company. Now here we see there is what will be the now here we are not to calculate anything, but we can even go further. We can see which company is beneficial, which company is losing. Now if we go by the same, which company is losing, so we can also find out the same. In this company, the company AB, that is company ABC will be stand lose, because the or equivalent EPS will be 0.702 instead of 1, whereas for a company XYZ it will be beneficial. Now next it says what is the desired exchange ratio, so that there is here what happens. Here see, now since you can watch this question, here there's a problem. Okay, because one company started losing, another company started gaining. Now it may possible, it depends which company dominates. Now here is presuming that XYZ Limited dominating, and that's why it may say, yeah, please, I want to maintain my APS. So in that case, what happens? That we have to make happy, or you can say we have to pacify the shareholders of our XYZ. So what happens? We first of all, as we computed earlier, what is our pre-merger acquisition EPS? 2, and what is our post-merger earning? 6,25,000. So this will be post-merger earning. Now out of this, it means if number of shares are 3,12,500, only this will be justify the EPS of 2 per share. Please note, this is the number of shares. If number of shares are this much, only this will be there. So what happens now? Since this already number of shares justify this EPS, and number of shares already issued is 2,50,000. So balance of shares that can be issued, that will become 62,500. Now 62,500 will be issued to equity shareholders of XY ABC, whose number is 1,25,000. So the ratio will become with this ratio, there will be then EPS of the company will remain the same. Now it may possible, I may ask you in the examination, or examiner may ask you in the examination, if ABC Limited wants to maintain their EPS. So there can another possibility also. That question you try at your own and see what will be the result. So with this question ends here. Now I am coming to another question, that is question number 16. This is from the practice manual again, edition 2015.
In this question,
yeah, let us go back to the query session.
Let's see whether there is any query.
No query. So this we can continue this session.
K Limited is considering acquiring L Limited. The following information is available. The profit after tax for K Limited is 50 lakh. Number of equity shares is 10 lakh, and the market value per share is rupees 200. For N Limited, the profit after tax is 15 lakh. Number of equity shares outstanding is 2,50,000, and the market value per share is rupees 160. Exchange of equity shares for acquisition is based on current market value as above. There is no synergy advantage available. Find the earning per share for company K Limited after merger. Find the exchange ratio so that shareholders of N Limited would not be at a loss.
Now here, friends, please note. Now here the N Limited is acquired company. Now in earlier case, we were saying the acquirer company's shareholder will not be at loss of EPS. Here it is saying the exchange ratio that we have to find where the acquired company should not be at a loss. So let us solve the question. Now first of all, I am just solving it quickly because all concepts have been clear to you. So without taking much time, and because there is one more problem I have to take, a very important problem I have to take. Now all data has been given to you. So exchange ratio is 160 to 100. It means 4:5. For 4 share of K Limited. Now here we can say K Limited is acquiring, okay, or you can say 4 share of 5 share of, or we can say write it reverse. For 5 shares of N Limited, 4 share of K Limited will be issued. So number of shares will be issued will be 4/5 divided into 250,000. Now number of shares will be issued, new shares will be issued 2 lakh. So with this, total number of shares comes after merger 10 lakh were already there. 10 lakh number of shares were already of K Limited. 2 lakh shares have been issued. So total number of shares. Student, I am not skipping some presentation aspect. So don't worry, you just refer from the study practice manual. And after tax, that is PAT, 50 lakh of K Limited, 15 lakh of Unlimited. So total comes 65 lakh. Now from this, per share. So here now it says ki the company and it does not want to be at the loss, and earning per share. First of all, we find out the earning per share of both companies, or we can continue even with the finding Unlimited. K Limited is okay. Now here we can see the EPS of Unlimited is greater than EPS of K Limited. Now it will say, why should I bear the loss? So he will say, I want to maintain my EPS as status quo. So for that, what happens? It will say, I am a share. We are 250,000 shareholders are there. Okay, each wants 6 rupee EPS. I'm just explaining you. The formula is there. For not formula, it's a simple calculation. So what will be the requisite? Our requisite will be basically 15 lakh of earning we require. Since your earning after merger is 5, so we need 3 lakh share of your company. So once the company issue 3 lakh share, total number of share what will come? 10 lakh existing share plus 3 lakh shares are there. So 13 lakh share will be there. Okay, and with this, what will happen? Our earning after merger is 65 lakh and 13 lakh number of shares, so rupees 5 EPS will be maintained. So we can see once we have carry out the merger on the basis of EPS, so both companies are not in a loss. So with this, I hope the exchange mechanism, exchange deal structuring must be clear to the student. Let us go back to the query session. We have not received any query. Okay. Now I am coming straight forward to some. There is one question because there is a time is less, and I have to cover one more point also. This is I am taking up the question number 24th. That is yeah. I am just let us Sandeep, please read out the question.
The following information is provided relating to the acquiring company Efficient Limited and the target company Healthy Limited. Number of shares of Efficient Limited is 10 lakh. Market capitalization is 500 lakh. P ratio is 10 times, and the reserve and surplus is 300 lakh. And the promoters holding in number of shares is 4,75,000. These are the information related with the Efficient Limited. And the for Healthy Limited, the number of shares of rupees 10 each is 7 lakh 5 7 lakh 50,000. Market capitalization is 750 lakhs. P ratio is 5 times. Reserve and surplus is 165 lakhs, and promoters holding in Healthy Limited is for 5 lakh number of shares. Board of directors of both the companies have decided to give a fair deal to the shareholders, and accordingly, for swap ratio, the weights are decided as 40%, 25%, and 35% respectively for earning book value and market price of shares of each company. With these information, you are required to calculate swap ratio and also calculate promoters holding in percentage after acquisition. The second requirement is you will have to find out what is the EPS of Efficient Limited after acquisition of Healthy Limited. That is the post merger, post acquisition EPS of Efficient Limited. And third requirement is what is the expected market price per share and market capitalization of Efficient Limited after acquisition, assuming the price earning ratio of firm Efficient Limited remains unchanged. That is, the P ratio of Efficient Limited will remain 10 times. And the fourth requirement is you will have to find out free float market capitalization of the merged firm or merged company.
Okay, thank you, Sanjit. Now coming back to this question, friends, see, there is jugglery of the words. Now, in the question, we have been providing market capitalization. It may be possible that you may be provided free float market capitalization. Had this one word been prefixed here, so your question will be changed. Please note, some student normally crams the question, as I told you, and they fail in the examination. And for this, I will refer you. You can refer the question number 26 of the practice manual, because this question is based on the free float market capitalization. Very good question. Now, my purpose of taking this question is nothing but I'm just reproducing the data, or you can say, again, I am here. He's insisting on the fair deal. Now, for fair deal, what is he doing? He is providing the weightage to the swap ratio on the basis of, see, what happens if we use EPS, it may be unfair for one company and another firm. If we may use price per share of equity, then it may be fair for one company and another one. So to overcome this, they may come to the swap ratio on a basis of weight of each factor that is decided mutually. I am quickly coming. I'm just coming to the. I'm just showing. Now here it is Efficient Limited, and here is Healthy Limited. Now I will quickly reproduce the data, and what is my purpose, since time constant is there. But one thing I want to make you clear, that one important point where student normally commit the mistake. First is market capitalization, that is 500 lakh, no issue. 750 lakh, no issue. Number of shares, no issue. Now market price per share, rupees 50, rupees 100. PE ratio 10, 5. From this EPS you can easily calculate, that will come rupees 5. That is, you divide this and divide this, that comes rupees 20. Now profit will be 50 lakh, 5, because number of shares are 10 lakh. Share capital is rupees 100 lakh, rupees 75 lakh, reserve and surplus 300 lakh, 165 lakh. So total comes to 400 lakhs here, 240 lakhs, and book value will be per share will be rupees 40 and rupees 32. So here we have got the basis. That is one basis of calculation of swap ratio. We have got the book value, and since market price is also there, so these three bases we shall use in calculation of swap ratio. Now since weightage is given is there, so on a basis of EPS, if we see 5:20, here we can see the EPS of one company is more, although the book value is maybe less and market price also more. Although the healthy company is target company, but now with this, the ratio will be now here. Since we have been given ratio, now we multiply with a 40%, that is weighted average. Now here it is a 2.5, means for one share of Healthy Limited, 2.5 share of Efficient will be issued. Friends, now for further question I am not solving because there is a time constant. But one thing here I want to, rest of the question I am not solving, that you can do at your own. Now what I want to tell you about, that is very important, and see, this question has come in May 2005 15 examination in the paper of SFM, and the question number was 5th A. So I am just simply, you just note down the question and just pinpointing on the was the correct, so you can say what was the basic aspect where the maximum student is committing a mistake. Now in this question, if we go by the question is very long and it will take quite long time to read it out. Now he has given the basis for the weightage. Now in this weightage, 30% for the gross NPA, cash, car, and 40 and 10. Now if we read the question, capital adequacy ratio is there, and there is one gross NPA. Now see, is companies bank R is basically, you can say, is facing a do or die situation, and since it has a debt ratio of gross NPA ratio is 40%, it means total capital, whereas on the bank P the gross NPA is only 5%. So student, what the student has committed a mistake. Now I am just coming to straightforward to the ratio first of all, because it was the first part of the calculation of the swap ratio. So now gross NPA, now this was to be like 5:40, not reverse, because if we do that way, it means the bank R, who is in a do or die situation, will be in a beneficial position. So gross NPA 5:40, car 4:16, market price 8:128, and book value per share. Normally, it has been given in your practice supplementary. This has been question is taken from the supplementary. So there it has been given, because although it is in an examination, but it has been given in supplementary also. So here the value has been given. So sometimes student asks, sir, how we have calculated the value. This value has been come. This is a per share value, and total value is 210 divided by 14 lakh number of shares. Similarly, total reserve and surplus is 600 lakh, 6,000 lakh, and divided by 50 lakh. So by this, it must be clear to the student. Now, please remember, it was the correct point of the question that this has to be ratio has to be reversed, not 40:5. Because had it been there, then the student must have got a, and then bank who is in a do or die situation will have got a benefit. Now, by multiplying this ratios with the weightages, we can find the value. So I hope the today's topic of merger acquisition must be very clear to the student who is watching this program. Now there is one question, was 32 number was question. Now I will request the student, please note down my phone number and email ID. Preferably you give me a call on Monday at the same number, or you can send me email. Preferably it will be better if you give me a call, because from the telephonic conversation I can make you clear more further concept. So with this, we end up the session. All this session must be fruitful to you. Thank you. Okay, question is there. Sir, if the question is silent regarding exchange on the basis of market value or on the basis of earning per share, what exchange? Yogesh Vyas, can you quote some question? Because sometimes this type of question, and sometimes there are some hints are always given. Like if market price has been given priorly, so you can go for the same. Normally, in most of the cases, market price are used on an exchange rate exchange basis. So I hope the session must be this session, or you can contact me over the telephone for your cleaner. Thank you.